In his second interview with us this week, Dr. Frank Hollenbeck joins us to discuss monetary policy and how this can impact or impede growth. Dr. Frank, thank you for coming into the studio with us once again. Now, this has been sparked from a comment that Nicolas Sarkozy made last week regarding the ECB. He stated that it's not possible for the central bank not to participate in supporting growth, like all central banks in the world. What exactly does he mean by this?
Well, the first thing I need to do is explain what is called the Fisher equation, and it's how interest rates are determined. For example, suppose that you're waiting for a bus. Okay. Would you rather have the bus arrive immediately or in 30 minutes? You prefer having the bus arrive immediately, in the sense that you prefer consuming right now, immediately, than having to wait 30 minutes. However, I can pay you a certain amount of money for you to wait that 30 minutes, okay? So the price I'm paying you to wait the 30 minutes, where you would be indifferent between taking the bus now or taking it in 30 minutes, that's known as the price of time. That's called the interest rate. And we have the same thing in real life. In real life, for example, I may have 100 apples, and I would prefer consuming those apples today. However, I can forego that consumption today if I can get more consumption in the future, okay? And you and I may have different time preferences of consumption. You may want to consume the apples today relative to me wanting to consume more in the future, okay? But for me to give you my 100 apples, you have to give me more than 100 apples in the future, okay? For example, you may give me 3 apples, okay? So in other words, I'm willing to give you 100 apples today, okay? And you're willing to give me 103 apples in the future. That is known as the real interest rate. Okay, and when we're dealing with apples, we don't have a problem with that. Okay, the problem is when we deal with money, in the sense that if I give you $100 and you give me $103 back in the future, and inflation was 10%. Then when you give me $103 back in the future, with $103 with 10% inflation, I can only buy 93 apples. So in other words, I've given you 100 apples and you're giving me back 93 apples, okay? The reason is that the inflation was unanticipated. In other words, we set an interest rate of 3% because we expected inflation to be 0. The fact that we had inflation, it basically benefited me, which was, actually it benefited you, which was the borrower, okay, in the sense that you only had to give back 93 apples and you were able to consume 100, and I'm the loser, I'm the lender, in the sense that I gave you 100 apples and I only got 93 back. And that's why we say that when we have unanticipated inflation, it basically benefits the borrower and penalizes the lender. And that's why a lot of people are pushing the central bank to print money, so that we have unanticipated inflation, so that the government can be basically pay back its loans with less real goods and services, okay? Now, the problem in the case of the governments is that if they have to roll, if the maturity of their debt is really short term, then they can only fool people into giving them more goods and services than they get back, only for the time until the loan is renewed. Because what will happen is that when you see that inflation is 10%, you're going to charge me 13%. In other words, you're going to charge me a 3% real rate, plus you're going to add on a 10% inflation premium. That's how we say that interest rates are set, is basically the nominal interest rate is the real rate plus the anticipated inflation.
What role then can the central banks play in setting these interest rates, and in turn, what impact can that have on growth?
Well, when we deal in the real world with real interest rates, okay? So if we have a situation, if we're in a situation where the real interest rate is 3%, and let's say that all of a sudden people decide they want to consume less today and they want to consume more in the future. So what they will do is they will save more, and what that will do is that will reduce the real interest rate. So in other words, by reducing the real interest rate, it's going to send a signal to businesses, because businesses are usually the borrowers. Businesses are the ones who are borrowing the money to build capital goods to produce goods and services in the future. So that when they see the real interest rates drop, let's say from 3% to 2%, it's basically sending a signal. It's saying, oh, society is willing to free up resources so you can use those resources to produce capital goods, to produce goods and services in the future. In other words, society has decided that it wants more goods in the future, and therefore the interest interest rate is basically informing society that it wants more goods and services in the future, and therefore we should invest in capital goods to produce those goods in the future. Now, what happens when the central bank comes in and it prints money? Okay, it basically comes in as, it masquerades as savings, in the sense that what it does is it sends a signal to businesses that society has freed up resources and the society wants more goods and services into the future. But in reality, that's not what's happened. Society hasn't decided that it wants more goods and services in the future and less goods and services today. What's happened is, as the central bank has come in and it's fooled businesses to basically produce more goods and services for the future. This is why what basically the monetarists say, or what a lot of government officials say, is that the central bank should come in, it should lower interest rates and basically fool businesses into making the wrong decisions, in the sense that they're producing goods and services that society doesn't really want. And what happens is that since society hasn't really freed up the resources that business can use to produce more goods and services in the future, what happens is that there's a struggle for the resources, and that causes prices to go up. So ultimately, businesses figure out that, oh, there hasn't been a drop in real interest rates. We've just been fooled, and prices have gone back up. So the role of the central bank in the role of it creating growth is basically to fool businesses into making bad decisions. I consider that to be a really bad type of monetary policy to follow. Now, in the case of Nicolas Sarkozy, he basically wants the government to follow a monetary policy that would lead to a cheaper euro. Okay. Well, what does that mean, a cheaper euro? It basically means that we want to follow a monetary policy that's even more loose or easier than your neighbor's monetary policy. For example, if we had hyperinflation in the US and hyperinflation in France, the exchange rate would be the same. So the only way you can have your exchange rate be cheap relative to your neighbors is by following a monetary policy that's easier than your neighbors. But that's doing the same thing that I just described, in the sense that what you're doing is that you're devaluing your currency, so you're getting a benefit to your exports until the additional monetary policy shows up in input prices and your competitive edge has disappeared. So this goes back to what Ricardo said back in the 18th century is mercantilist policies, okay, which is to subsidize your exports and restrict your imports, ultimately is self-defeating. And the same thing is true about that type of monetary policy, which basically leads to a cheaper currency.
Frank, thank you very much. Dr. Frank Hollenbeck there. That's all we've got time for right now. However, do stay tuned to Dukascopy TV. We'll be bringing you exclusive interviews from Lloyds TSB Private Banking and also the April ISAG update. For now though, goodbye.